Welcome to the Street Stocks and Market Podcast, where we focus on, well, you guessed it, folks, what's driving the stock market, the economy, and individual stocks. I'm Chris Versace, portfolio manager of the Street's Pro Portfolio, and joining me this week to break it down and share what he's seeing is David Miller, co-founder, chief investment officer, and senior portfolio manager of Catalyst Capital Advisors and Rational Funds. David, thank you so much for joining me.
Great to be here.
So, David, we're kind of at this weird point in the market. We've had a tremendous run. There's renewed uncertainty on the trade front, questions about the speed of the economy, inflation. What are you seeing? What are you thinking? What are you sharing with your clients?
Sure. So when you look at markets, things have certainly calmed down quite a bit since the peak of the trade war. It looks like Trump has made it clear he really wants to show that the stock market can go up from here, and he's willing to do what's necessary to make that happen. Additionally, of these challenges in the courts as to whether he has the right to put his tariff plan into place. When you look from a Fed perspective, they're in a bit of a tough spot. You know, I think conceptually they would like to actually be able to raise rates, but practically, when you look at the last GDP print, it tells them, hey, maybe they should be cutting rates a little bit. You know, it's kind of that quagmire that you get into when things look like they could be stagflation-like, although I think that was more a product of what was going on with the rate hikes that we had back in 2022 and the lag effects associated with that.
So, David, let me just back you up a second. So there's a lot of folks out there, you know, you look at the CME Fed Watch tool, they're saying, oh, the Fed's got to cut rate 3 times this year. But you just said you think the Fed wants to actually raise rates. Now, that's kind of counterintuitive.
I don't think there's any chance the Fed actually would raise rates. I think when you look at inflation, conceptually, they've always promised this 2% target. We're not that far from 2%, but it doesn't necessarily make the most sense to say you have a 2% target to be a little bit above 2% and then be cutting rates. So it's a bit of a quagmire, but frankly, they can just keep rates where they are from a pragmatic standpoint. I don't think that they have to cut. And, you know, from an inflation standpoint, it might even make sense if they raise slightly, but that's not going to happen.
Okay. So, I mean, my view is that the Fed is not going to do anything until at least September. I question whether or not we're going to get 2 rate cuts this year. I don't know if you saw it, but, you know, as we're taping this, Atlanta Fed President Raphael Bostic was out today saying, you know, I could maybe see 1. You know, I just think that there's room for the market to be potentially disappointed, depending on how the Fed communicates, you know, dialing back the number of rate cuts from the 3 the market sees potentially with the next SEP exiting the Fed's June meeting, going down to 1 rate cut. Remember, the March one had 2. So maybe they're, you know, potentially easing the market down, trying to get the market comfortable with the notion that, hey, we're not going to deliver as much as you might think.
Yeah, no, I think you're onto something there. I don't think there's any real indication that there's a possibility that they're likely to go ahead with 3 rate cuts unless something really starts to collapse in the economy.
I totally agree. But we haven't seen it yet. I mean, we'll have to see what the upcoming data brings. And we are kind of in a big data week. We've already had the May ISM PMI numbers. Personally, I'm looking forward to the May service PMI numbers. Is there anything out this week that you're really focused in on from a data front?
I would be focused if I see a real surprise from what I'd be expecting otherwise. But I'm not really expecting surprises right now. But I don't have any particular data point that I think will be very different than market expectations.
Okay. And are you kind of concerned at all with this Atlanta Fed GDP Now forecast? You know, it's a rolling forecast. And exiting last week, it was like 3.8% for the current quarter. And after yesterday's manufacturing PMI numbers, it actually popped higher. I was totally surprised by that. I thought it would have been revised lower, but it was revised higher to 4.6%. Or do you think the OECD is right that we need to be dialing back our expectations for GDP this year?
Yeah, no, I mean, those expectations do seem a little bit high as to, you know, what they're communicating. I think we're going to have a decent GDP growth, but I don't think it's going to be quite there.
Okay. Okay. So from a market perspective, is there anything you're eyeing that would help the market move substantially higher from here, or do you think we're in a period of, as some technical analysts like to call it, digestion, where we're gonna, churn sideways for a little bit, or perhaps do you see some more downside risk near term?
I don't see a whole lot of additional downside risk in the near term, barring some big event that's completely out of the norm. I think when you look at the changes that have happened recently in expectations, when you think about it, when Trump kind of came into office, there was a lot of rhetoric about tariffs. Obviously, he did
Hmm.
try to go ahead with those, but then he wound them back. There's a lot of talk about Doge, and he started with Doge. But then when you look at this most recent bill from the House, it looks like the reality is things are heading in the opposite direction.
Right.
Sure, there's a little bit of tariffs that we've added, but it looks like we're actually going to continue to have a deficit similar to where we had it. It looks like we're going to continue to grow that $36 trillion debt load at a pace of probably about 5% annualized. So that's actually, I think, a pretty good thing for stocks on a go forward basis. I don't think that's a great thing for the purchasing power of the dollar or inflation.
Okay. Okay. So you see more dollar headwinds coming, or no?
So I don't think it's specifically from the macro environment. I think it's more just
Mhm.
from deficit spending combined with this scenario that we've had ever since 2022, when after the Russian invasion of Ukraine, the U.S. Weaponized the dollar against Russia to effectively seize $300 billion of Russian central bank assets. Once we did that, I don't think any of these other emerging market banks feel comfortable relying on the dollar given what we did, to Russia. You have to imagine if you're China and you held $750 billion of US treasury bills and you just saw that, Russia had 300 billion of theirs taken, you'd feel a lot more comfortable if you held more gold in vaults in Beijing and, less US treasury bills. So I think that's the biggest issue for the dollar over the long term is a combination of the deficits and de-dollarization from the EM central banks.
So are you looking more domestically focused with Catalyst these days, or are you looking at international opportunities?
I'm pretty much almost always more domestically focused. The macro is much harder to predict, and on a micro basis, you can find wonderful companies that are very likely to do quite well in any relatively normal macro environment. So I think that that's the easier way to make money,
So
aside from huge macro trends like I think gold is a no brainer right now given what's happening to the dollar.
it kind of begs the question, right? Are we in a normal macro environment? GDP looks good, inflation, yeah, hot, but how do you see those tea leaves coming together? Or normal environment, not so normal? Where's the opportunity?
So I guess there's different variations of that. So are we in a
Mhm.
normal like we had in the 90s when you had deficits that were roughly sometimes turning into surpluses? Certainly not. Are we in a more
Yeah.
similar environment to what we've had over the past 8 years or so? Yeah, I'd say we're still in that environment. But as that environment continues, that likely is good for large cap growth stocks. That's largely not great for people holding dollars. That is likely good for gold and Bitcoin and hard assets.
Okay. Okay. So let's talk a little bit about Catalyst because you are the CIO there. And for the folks not familiar with it, what's kind of your investment strategy, if you will? How do you see the world? How do you select, positions for the portfolio?
Sure. Well, so at Catalyst, we're not just Catalyst. We're Catalyst Rational Mutual Funds and Strategy Shares ETFs. We're
Okay.
roughly 30 different funds, about 12 billion in AUM across those, and each one is its own kind of variation of a unique hedge fund type, like strategy in a mutual fund or ETF wrapper. So if you think about our largest fund, our flagship, the Catalyst Milburn Hedge Strategy Fund, that fund is half managed futures, half equity ETFs. Now, the magic to that is that it doesn't fit the style box, but it does fit what Markowitz told everyone to do, which was to diversify. And he didn't mean go out and buy 500 stocks. That's 500 versions of the same bet. He meant invest in some things that do their best in bull markets and some things that do their best
Right.
in bear markets. And managed futures tend to do their best in bear markets because that's when you get big trends in the market. Equities do their best in bull markets and obviously poorly in bear markets. So when you combine the two, you can add the returns of the two together, which is why, fund like that beat the S&P 500. But adding the two together is also a bit of a natural hedge, which is when you look at why in every major bear market, that fund's been up, 2001, 02, 08, and 2022. It's clearly the managed futures driving that. So that's kind of the idea behind what we're doing is we're trying to get out of the style box and go back to first principles and say, what is the right way to invest if your goal is to put up the best risk-adjusted returns?
Okay. So talk to me a little bit about the equity side of the house, if you will, in that particular fund or just in general. What's the process for, picking stocks for the fund? Some folks are more fundamental, some are more technical. We're a blend of fundamentals, technicals, and thematics when we talk about the pro portfolio. But what's the secret sauce or the, investment mosaic, if you will, over there?
Well, so in terms of that fund is sub-advised by a firm called Milburn Ridgefield. They've been managed futures experts. They've been doing that for 50 years. Their equity piece is globally diversified equities, but their special sauce is the managed futures overlay that both adds return and downside protection. But when you look at what we're doing more internally, like we recently launched an ETF, MPLY, the Monopoly ETF.
Oh,
And
yes, 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 yes. Go ahead.
yeah,
Sorry. I was just reading about this. That's great.
Yeah, so when you think about it, there's a lot of things that Peter Thiel has written about how your goal in business is to avoid competition. You're either in perfect competition or you have a monopoly or an oligopoly. And clearly, anyone who owns a business wants to be in that position where you have a monopoly rather than being in perfect competition. Historically, airlines haven't even earned their cost of capital
No.
or frequently end up going bankrupt. If you look at restaurants, terrible businesses that have very high fixed costs, they're very cyclical. They just never earn outsized economic profits. Whereas you look at a company like a Visa or a MasterCard or a Microsoft or an Apple or an Adobe or an NVIDIA, phenomenal businesses, phenomenal margins, great tailwinds, really strong free cash flows. Why do you have to invest in the companies that aren't monopolies or oligopolies when all the best returning stocks in history have turned into monopolies or oligopolies? And I think, frankly, you don't have to try to pick which stock is going to be the best stock. You can just take these categories of businesses that are far superior businesses and invest in those. So that's kind of the ideology behind that fund, and why we launched it, because we thought, yeah, it's hard to beat the S&P 500 because if you miss an Apple or a Microsoft or a Visa or an NVIDIA, you're
Mhm.
naturally going to underperform because those companies turn into 100 baggers. But if you invest in every company that has great monopolistic characteristics, you don't have to miss those. And we've never seen this situation where you have a company that's in perfect competition that turns into a tremendous grand slam home run like those companies did.
So as you're watching an industry evolve, is there something, some rule of thumb that you're using that says, aha, yes, this is the monopoly company that we want to invest in? Or are you just looking more in, when you talked about some of those industries, they're more mature, so you can kind of more readily identify the likely players that you might want to invest in with that strategy?
Well, when you look at the biggest players, it's, to your point, fairly obvious. If you want to buy a computer and you want it to work, you need to buy Microsoft software. If you
So
want to
now
make a transaction with your credit card,
I would have said Apple, but same side of, different side of the same coin.
sure, but a different variation of a monopoly or an oligopoly in the sense
Yeah.
that once you're in the Apple ecosystem, they own you. You don't have a whole lot of choices, and they can get great margins.
I would say this about that as someone who's been trapped in the Apple ecosystem willingly since 2005. I am perfectly content and happy.
And I certainly understand why a lot of people, love Apple. I certainly have the iPhone, and I like Apple. And I don't particularly like Microsoft, but I'm definitely a customer of
Understood.
Microsoft.
As
So I
am I.
think the
As am
best
I.
businesses are those where you'll do business even if you don't like them.
Fair enough. Fair enough. Fair enough. So, what about there were some other names that I saw in getting kind of ready for this, and I think Tesla was one that you guys have identified as well. Is that in this particular strategy, or is there another strategy that they fit into, or maybe both?
So Tesla is in this particular fund, and I think Tesla actually does fit the dynamic. They launched a new monopoly or an
Hmm.
oligopoly, depending upon how you look at it. Certainly, from a market share perspective, within EVs in the U.S., you could say that they're a monopoly. And once you decide you're going to get an EV, it's a lot easier to go ahead and buy a Tesla and be part of their ecosystem and chargers than it is to buy an EV that's not part of that Tesla ecosystem. So whenever you see a situation where they have the margins that they do at Tesla, which are incredibly abnormal in the car business, and hard high switching costs, that's a pretty good indication that they're a bit of a monopolist. But frankly, one of the most straightforward telltale signs is the courts. Once the courts start coming after you for being a monopoly, that's a pretty good indication that you have some monopolistic characteristics in your business, whether or not you want to admit it. And if you look at companies historically that have had the courts coming after them for those monopolistic characteristics, they've actually been phenomenal investments. If you got into Microsoft when the courts first came after them pretty hard, you'd be sitting pretty today.
True, true. So I have to ask this question then. So if you look across the Mag 7, I would suspect you have all of them, even including Netflix.
Yeah, that's true. So basically, all of the Mag 7 you could say are monopolies or
Okay.
oligopolies. Yeah.
Are there any companies in this strategy that might surprise anybody?
I don't think it's so much that you'd find that the names in the strategy are things that would surprise people. I think it's maybe more what's not in here that might surprise people a little bit. Because if you have an electric monopoly, uh, sure, that is a monopoly, but it's not the type of monopoly we invest in. Meaning, once it's a natural monopoly, rather than they built a product that everyone wants to use and then
Right.
developed high switching costs and benefits to that network, then they can't earn monopolistic profits or economic rents the monopolist would. So if you're a water monopoly, or if you're a Comcast, or if you're in a space where you have a product where your profits are regulated as to how much profit or how much return on equity you can actually generate, we actually avoid those because what we want to go for is those that are growing monopolies. So if you look at a company like Intel, sure, they used to be a monopoly, but once you see that company starts going into decline, we don't want to be owning something that used to be a monopoly. So we're looking for growing free cash flows, growing revenue, high margins, high return on equity that indicate that they're currently a monopoly and growing as a monopoly rather than contracting or a regulated monopoly.
Yeah. So kind of underneath it, it sounds like you want companies that people are voting, you could say with their feet, or more importantly, with their wallets, choosing to choose these products. Whereas, you mentioned, water utilities, electric utilities. Most people don't have a choice, right? They're, as you said, they're more natural monopolies just by the limited factor that they have. Um, you know, but let me get to the point where you talk about, like Intel and the decline. When you guys start to measure these declines, is it 1 quarter, 2 quarter? Are you looking, for a year? How do you, because it's a big trigger to pull and make that decision.
Yeah, we're really looking for a combination of two things. So if it isn't in decline, the stock price trend will tell you that, and it'll be kind of
Mhm.
visually obvious on a chart. So from that perspective, it's technical. You can also see it from the free cash flow statement or from the revenue statement. If you see revenue and or earnings in multi-year decline as opposed to some cyclical bump or sell-off that's more economically driven, uh, those would be the scenarios where we'd say, hey, this looks like it's on its way out rather than a growing monopoly.
Okay. Okay. Any other areas in there? I feel like, credit rating companies, some of these stock exchanges might be candidates for this strategy. Anything else?
Yeah, no, there's a lot of those. If you think about a company like FICO, and to your point, if people like a product, that's great. But what I'd really prefer is actually that they need the product rather than they like the product, and that there's some growing demand around it. Meaning, like if you're Visa or Mastercard, nobody's making an active choice to use Visa or Mastercard, but Visa or Mastercard don't really have any cost of goods sold either. People are
Right.
naturally switching internationally from cash to cards. Inflation
Hmm.
is good for them. So certainly in the payment space, a Visa or a MasterCard is a tremendous example of that. Similarly, if you're like FICO or Fair Isaac, you need a credit score if you want to go out and get a loan, and that you're not going to be that price sensitive for getting that credit score if you're about to take out a mortgage that's several hundred thousand or million plus dollars. You're not going to not be willing to pay a dollar more for that credit score and say, you know what, FICO, I'm not willing to pay you for that credit score. Those are the ones we really want to be in.
Yeah, yeah. I feel like, in the portfolio, we have a couple different inelastic, what I call business model opportunities in the portfolio. And it sounds like you're saying that these kind of check that box as well.
Yeah, same thing applies. Like if you think about like a TransUnion or an Equifax, even
Hmm.
after people lost all their private information to a company like an Equifax, nobody said, "Hey, I'm not going to be in the Equifax database anymore."
Right,
So
right, right.
those are, I think, those sweet spots where you have such a good business that even if people hate them, they continue to grow and grow with high margins and high EPS growth.
No, that's interesting. It's, you raise, in my opinion, a lot of interesting points about this. And I know that, like in the portfolio, we have some of these names, but we don't have some of the others. And it's kind of an interest. It's a different lens with, and I like that. It's the same, similar in respects to why we lean into thematics. In order to, in my opinion, to outperform the market, you have to think differently than the market. And I think this captures it in a slightly different way from what we do. And I kudos to the strategy.
Yeah, I think the interesting thing when you look at it historically is it's not what you're paying in terms of valuation. It's really what happens with the EPS growth of that company and how
Correct.
inevitable is that. So those companies where you have to be on top of a trend and people have to really like you, those are really hard. But if you thought about what was Visa or MasterCard 12 years ago versus what are they today, certainly their stock price is tremendously higher, but it was inevitable. There wasn't anything that you had to predict was going to change for those companies to continue to do very well and continue to grow. And that's what we really like, is when we can bet on the inevitable rather than a hunch that we have as to what we think the future will look like.
Right. So what's the turnover in the ETF? It's got to be small.
Well, we just launched the ETF, but the turnover is going to be very small. It's going to be essentially, yeah, we would have owned an Intel a long time ago, but we wouldn't own it today. We would have
Right.
owned Comcast when they were growing, and we wouldn't own them today. But the probability that we're not going to own Microsoft 3 years from now, I'd say, is very low. The probability that we're not going to own Visa or Mastercard is also very low. The possibility that we won't own Google, maybe that changes. Maybe OpenAI takes over and they come up with a much better search solution. So there are possibilities. Things will change, but it's going to be single digits type turnover that we expect.
Yeah. I mean, I don't think anybody can say that they're locked forever, right? That would be the
Of
equivalent,
course.
as I like to say, crockpot investing, fix it and forget it. You can't do that. You have to be an active investor, in my opinion. And that doesn't mean you're an active trader. That doesn't mean you're flipping positions around. But as we all know, and certainly we've seen over these last few months, things evolve, things change, and you have to adjust your thinking as fresh information becomes available. So, David, is there another big strategy inside of Catalyst outside of Monopoly that we should be talking about?
So when you look at what we're doing, another strategy we look at is insider buying activity.
Okay.
And when you think about buying activity, clearly I know some things about firms and I know things about the companies that I invest in. But there's virtually no way that I can, as an individual investor, know more than the collective intelligence of the CEO, CFO, chairman of a particular firm, certainly in the aggregate of that company for their entire management team. How am I possibly going to know more about that business than the entire aggregate management team of that business knows? So if you can look at what they're doing with their own money, if they're all
Mm-hmm.
buying their stock in their own firm, even though a lot of their livelihood and their net worth and their stock options and their RSUs are already tied to that company, that's an incredibly good sign. And it's an especially good sign that they're not going to default on their debt. Because, well, certainly an executive, if they know that they have just got the cure to cancer and they're a biotech and they're about to get approved and they have some special information, they're not allowed to buy right ahead of that. But there's certainly no law anywhere that says that an executive who's privy to material non-public information, that something really bad is going on at their firm, there's no law that says they have to buy their stock
Right.
right before
Right.
they declare bankruptcy. So by default, you can avoid those situations by avoiding the companies that insiders are selling heavily or those that they're not buying. So we have a short duration investment grade corporate bond fund. It's called the Catalyst Insider Income Fund, IIXIX. And I think the reason that fund's been top decile past 10 years or 5 years or 3 years isn't that we're predicting the future better than anybody else, but rather that the insiders give us a really good tip off as to whether or not they think their company is going to be solvent enough to service their debt by buying their own stock as an indicator. So that's kind of an interesting lens to look at, I think, aside from monopolies, because in equity investing, the key is identifying those companies that are going to be the tremendous winners and letting them ride, because that's where all the returns come from, a very small slice of companies that turn into the 100Xs or the 1000Xs of the world. But when you look at it from the perspective of bond investing, the real key is avoiding the losers, not investing in the winners.
So with this particular strategy, David, how many constituents are there in the ETF? And I'm just asking because, you have to cull through a lot of, filings, obviously, to capture this information, but not all stocks have insider buying in all periods, all quarters. So how do you, identify those companies and kind of make sure you have enough stocks or constituents, I should say, to keep the strategy going?
So we have a ranking system that ranks each company from a 10 down to a 1 based on how many executives are buying, how much they're buying, what their rank is at the company, how many are buying and or selling at the same time, what their record to their insider buying or selling activity has been historically. And then we use that rank from 10 to 1 to, we don't pay much attention to those that are ranked below 7. And then we do a deeper dive that are a 7 or higher.
Okay, so just because a company might see some buying in a particular quarter does not say, oh, it automatically gets folded into this product.
That's correct. So it's not automatic. The prerequisite is that we see a high insider buying score. And then what we really care about after that is, well, what if those insiders are wrong? How can I tell ahead of time if there's a possibility that they could be wrong? And frankly, what we found is when it comes to debt, there's one really easy indicator, or a couple that are really easy indicators as to where you're taking a material risk. And one is if that company is very levered. The other is when you compare the debt to equity ratio. And if you see that a company has a very strong debt to equity ratio and they've got a lot of cash on their balance sheet, that company is incredibly unlikely to go bankrupt. If you see that that company is extraordinarily levered, that company is far more likely to go bankrupt. But I think that's a bit of the irony as to how we approach fixed income investing versus, how the rating agencies like an S&P or Moody's would work, because I don't think anybody in their right mind who looked at the leverage of a Lehman Brothers or a Citigroup or an AIG going into the financial crisis would say these companies have very little leverage. We should rate them investment grade, or for AIG, AAA. But if you just did a common sense check and said, well, what's the leverage look like? There'd be a very easy indicator to tell you, hey, you probably should not consider this to be a low risk situation. Certainly not a AAA that would be, extremely bankruptcy remote in the case of AIG, or that actually was right on the precipice, or Citi or Lehman, where Citi had to get bailed out in a pretty big way, or Lehman actually went under.
David, you had me at common sense.
Common sense can go a long way sometimes.
Yes, it can. Yes, it can. On the one side, we always say that folks can fall victim to too much data analysis paralysis. But the other side of it is, sometimes folks make things way too complicated, and I think common sense and asking sometimes a couple key questions can carry you a lot further, a lot faster. You don't, as I say, get lost in the sauce. Quick question for you. So I totally understand the strategy behind investor buying. Do you have a strategy with investor selling? And the reason I ask that is I think that's a little trickier. From time to time, you can get good signals if you're managing insider selling, but not all insiders sell for the same reason.
So when it comes to insider selling, most of the data that you get is frankly useless, or sometimes it's even a good indication that they're selling. Meaning, like, if you look at a company that's been doing very well, very consistently, and the executives have an enormous percentage of their net worth tied up in that firm, by default, those companies are going to have selling. So if you look at the
Sure.
Mag 7, while they're tremendous monopolies, in aggregate, they're going to have insider selling because, if I started Google or if I started NVIDIA, there's no way I'd be buying more Google or Nvidia if I had tens or 100 billion plus of their stock, no matter how much I liked it. What you're really looking for with insider selling is changes. If somebody starts buying and then they flip to selling, or several executives flip from buying to selling, or if they weren't selling and then
Right.
they all start selling at the same time while the stock price is declining, that's what you're really looking for. So you want to avoid stock option exercises because they tell you nothing. You want to avoid companies where they're doing well and they have insider selling. What you're really looking for is where is a material significant change taking place.
Totally agree. Totally agree. David, I got to tell you, you've been very generous with your time. I really appreciate it. I hope to have you back. But before we get out of here today, is there anything that we didn't talk about that we should?
Oh no, I think we covered a lot of key bases, but I think what we did tap on a little bit in terms of gold. I think gold is going to be a tremendous opportunity over the next 3 years. Aside from equities, I am bullish on equities, but when you look at the collective buying of the central banks, they bought over 1,000 metric tons in 2023. They bought over 1,060 metric tons in 2024. And then when you combine the impact of the weaponization of SWIFT and the back and forth with tariffs this year, there's been points where they've been buying more gold than the gold mines are actually producing. And this trend towards de-dollarization after we were willing to weaponize SWIFT against Russia is not a trend that is likely to reverse unless we give Russia their money back.
All right. Well, you know what? I will. I'm not sure I'm going to take that bet, but I will say this. We will have you back in the coming months to kind of follow up on gold as well as some of these other strategies. What do you say?
Sounds great to me. Looking forward to it.
Awesome. All right, folks. That is the latest edition of the Street's Stocks and Markets podcast. Thanks for joining us. We'll be back with a fresh episode before you know it.